Hello, everyone, and welcome to another webinar with Ben and Cata on the Thursday afternoon. Please let us know in the comments if you're here, what you would like to see, what we're doing, and generally how your trading has been going. We're really curious on how you're doing. How are you doing, Cata?
I'm doing great, as always. In the morning, pump it up here, then ready to learn a bit more about crypto trading. I'm quite excited about what we're doing, and I even asked the team today what they think or what else we should do. And I also want to ask you guys that are looking at us if you have any other ideas or suggestions on, or I don't know, maybe you want to see something else. Just let us know, okay? Because we are really trying to improve and try to help you guys as much as possible.
Correct. We see Josephus, we see Heidi. Starting to become some regulars here. It's always nice to see. So what are we going to discuss this week? We're going to be talking about moving averages.
Let's move then.
So this webinar is going to be a bit average, but it's okay.
Well, it's not always bad to have an average profit, you know.
An average profit. Yeah, well, I mean, it depends on how good you are, right? You can have a massive profit or you could have zero profit. It just depends on how you progress in trading. Because it's not so much about like me telling you which strategy works and which doesn't work, because I'm not here to tell you that. I'm not here to dictate you any trading strategy. I'm here talking about different strategies and how you could apply them, and I could show you some examples of how they would play out for instance. But perfecting the strategy is ultimately up to the trader, right? But in this case, we're going to show you something on maybe some new insights on maybe how you can use the moving averages to improve your trading. So, shall we get a chart in?
That would be great. And before starting, Ben, I just want to announce again our trading summit that we're gonna do in Toronto.
Oh yes,
15th of May. If you guys are interested, I'm gonna drop again the link in the chat so you can see for yourself. We're gonna make more announcements about it. But yeah, it's something that basically will be on site. You're gonna be able to meet us and Aaron, because we are doing this trading summit in collaboration with Aaron from the Better Traders. Pretty much, will be May 15 in Toronto, Canada. I'll drop the link in the chat, and there you're gonna be able to attend a live course that we're gonna provide for any of you. So
exactly.
Yeah.
And if you're not interested in Consensus, for example, which is close by, then maybe you've always wanted to see the Niagara Falls, which is just around the corner.
Yeah, that's true.
So follow a course and enjoy the Niagara Falls instead of going to Consensus. Why not? You know, the course will be really good. Yeah. All right. Let's get to charting, because this is just I've got the right button.
Push the button.
Oh, we have Josephus saying, I'm still learning the concept, so for me, more smart money videos are welcome. Well, they will be displayed, or they will be done next Tuesday, another one. And then we have one from Roman himself. Moving averages are also useful as secondary confirmation in smart money. Okay.
Great.
That's new information. Right. I did not know that. No, that makes sense though. So, moving averages. What are they? Why are they useful? So what does it do? Well, normally when you have the chart like this, right, there's a lot of price action. So you see, especially if you zoom into the candles, you see a lot of ups and downs, ups and downs, ups and downs. So that can be sometimes a little bit difficult to determine which direction the price is actually moving, right? So what traders use is a moving average, meaning that it shows you an average price, a line of the average price of the historic candles, and in principle, that's what it is. So it gives you a softened line of the price, so that it's more clear, more easy to see where the price is currently, in which direction it's going. And then there's two mainstream ones. So let's see if we can get a moving average on the chart. There we go. So we now have a moving average with nine bars. And you can see that this line is now smoother. It doesn't have these jagged lines, and the price can go up or down below it or around it. Really, it will always hug it. But here you can see that the price is currently, or here you can see that the price is bouncing off this this blue line, the moving average, indicating that it's clearly in an uptrend. When it's sort of hugging it around, then you get the sideways movement, and then here you can see it where the price is constantly trading below the moving average, indicating that it's a longer term downtrend. Now, of course, there are different settings that you could use. So you could set the length. That means that you set the amount of candles you look back to determine the moving average price, the amount of candles that the moving average is based on. So in this case, it would be 9 candles, but you could change that to different settings. Let's say 21 or 50 or 200. And then you have the source, which means which price of the candle is actually used to create the moving average. Now, most traders will just use the close. And the offset can offset the candle a little bit, but not really widely used. Then you have the option between these three, which is the simple moving average, where every price weighs the same. And you have the exponential moving average, where the most recent prices make the same. And then you have the weighted, where this is similar to the exponential moving average. And this one adds a weight to the beginning of the moving average, if I'm not mistaken. So the exponential moving average is what is widely used. Many traders use the exponential moving average because it favors the most recent candles. And one thing to keep in mind is that the moving average is a lagging indicator by its nature. What does that mean? It means that the price that the value that you see is based on the historic candles. And it tells you what has happened. It doesn't indicate you where the price is going. It just indicates you where the price has been moving towards in the last few candles. So that's why it's a lagging indicator. And that's why people often use it with the EMA, because the simple moving average is even more lagging. So with the exponential moving average, you have the least amount of lag. So this is for a single moving average. Now, this is all nice, so understanding how a moving average works, but how can you use it for trading?
Yes, that's the thing that we want to know.
Yeah. Have you ever traded with moving average before?
No.
Has anyone in the chat been using moving average to trade before? Or are you just using it for confirmation on a strategy? Well, anyway, I looked online for you guys and looked at what people tend to be using for moving average trading. And they talk about principles of a golden cross and a death cross trading. That's as one strategy, meaning you look at two indicators where you have a long or a fast moving average and a short moving average, or a slow moving average, I should say. Now, how do you set up a fast and slow? Well, actually, what I'm going to be doing is I'm going to be setting up a triple moving average like this. I like to use this one. And then the standard is 14, 21, 35. Now,
Okay.
For what I'm going to show you today, I've actually been looking at something, and it uses, the first period is a 9, the second is a 21, and then we have the 200, like so, and we set it to exponential. Now you see, every time that I made some changes, the moving averages change, and you could play with the settings and backtest your strategy to see which ones work fine for you. Because that's ultimately what it's about, right? So it's nice to have moving averages on the chart, but it's also about perfecting your trading strategy. Now, I was saying about the golden cross and the death cross. Do you know the difference?
No idea.
No idea.
I assume it should be like bullish and bearish or something like that.
Yeah, correct. Yeah. A golden cross sounds very bullish, right? Sounds very positive. And
Exactly.
if we look at it here on this, in this bit of time frame, then we can see that so in this case, the orange cross, or the golden cross, not the orange, but it's the orange is the fast one, this is the slow one, and this is the 200. So when the fast one crosses over the slow one, that means that there's a golden cross, right? And this is when you look at that, then you may interpret that as a buy signal, meaning that the price is likely to stay above the slow line, right? And then for the death cross, you have it in the opposite direction. So as soon as the fast moving average drops below the slow one, that signals a bearish move. And here you can see that the price continues to stay below the slow line, right? So if you had sold here, then you would have made a very decent profit if you waited until you saw another cross again. So that's one type of strategy.
I mean, Ben, just a second. I think this is super easy to use them. I mean, just by looking at this, you already have like a good information of what happens in the market. I'm not saying we should take this as the golden thing that, this is how it happens. However, it's quite easy to get some information out from the market by using them.
Yeah, no, it is. It is very easy when you look at it like this.
Yeah.
But if it was that easy, then we wouldn't have a job, because we wouldn't need to explain this and everyone would be using it.
I agree.
Because it is actually a lot more difficult, and the reason for that is because of its lagging nature, right? If we look at the chart, if we look at it here, like this is where it crossed over, right?
Yeah.
But actually, we knew that after this candle had closed, right? At any time during this candle, it can still drop below and actually make this not a cross.
Mm-hmm.
Right? So we have to wait for the actual cross to be confirmed, right? And then we get into this candle, meaning that we would have to find an entry on this candle somewhere. Right, or you YOLO in and you set a market order right here. Roman is asking, is that a change of character plus golden cross? here and golden cross is here. So yeah, I would say that it's a change of character plus golden cross. But yeah, that's the issue with just trading the golden crosses, right? You cannot, because you have to wait at least one candle for it to confirm, right? And then in this case, you could enter here, and then by the time it lowers here, so you're selling here. So actually, if we look at the candles that we could potentially be in, here is the cross down again. So then it's actually a 4.5% move, when actually the potential was even 13. Right? So that's a difficult thing to master. Like, how do you find the better entries that give you the better risk reward ratios? So that's why it's good to have something else with this, right? So so just entering blindly on a golden cross or on a death cross, that's not a great idea, right? So what can we do? Whilst I was looking for something today on how can we combine this with, so we're in the moving average and we're on a higher time frame. What can we do using moving averages and finding a better entry? Well, what we can do is we can go to lower time frames, and we could find perhaps another entry confirmation, or a better entry confirmation for our golden cross on the high time frame. And there's another way, if you look at it, on where you can enter, because this is a golden cross. But another popular way to use moving averages to enter is on bounces of the moving average. So as you can see, the price is going up, and then as a magnet, it's drawn back to the moving average. Then it goes up, moving average touching, even this one touched, going up, touch, going up, touch, breakthrough, going all the way almost to the 200 moving average. And then this consolidation phase happens. So this is in any type of trading, this is always hard. Apart from grid bot trading, then it's great, but that's not what we're doing here. Yeah. So looking back, go into a 200 moving average, and then again you can see price always trying to come back to that line. So the other type of entry could be to look for bounces off a moving average, and we can do that on a high time frame and on the low time frame, of course. Does that make sense?
Yeah.
Okay, so the other thing that we could do in this case is so a way to so what I was explaining about the exit here, like on another or on a death cross where you exit there, that might actually be too late, and maybe you want to find a way to exit earlier. And you could just use support and resistance for that, right? So you could set your take profit targets to previous support and resistance, because oftentimes the price will reach support and resistance and then pull back to a moving average. And then it can either bounce off the moving average or drop through it, and maybe there will be a short entry coming up soon. So that's a little bit on the types of entries and the types of exit that we could use. Now, obviously, I want to see how that works, right? So, as anything, if you come up with a new strategy, or if you want to try out a new strategy, if you want to perfect it, then you need to do some backtesting, right?
That's the first step. And good that we have something in place for that.
I'm going to try it again. I mean, on Tuesday it didn't work as well.
Yeah, but It's not in production.
No, it's not in production, of course. We wouldn't push this to production, but I just love this tool, and I just like to use it a lot, and especially when it does work out great, then it's awesome. So let's see. So first off, a strategy could be, so we're looking for the golden cross, right? So the golden cross happened here, but we also look at our 200 EMA. If the price is trading below the 200 EMA, then we favor short positions. If the price is trading above the 200 moving average, then we're looking for long positions. And now, quickly, why is that? If you're seeing this, looking for short entries, that's ridiculous, right? You would agree with that, right?
Yeah.
Here, you could be looking for shorts. If the price continues to go down, then you could ride this wave, but then all the way down. So we favor short positions. And here we favor long. Here, this is always difficult because you can see that it's like there's a high debate about the price consolidation, moving sideways, blah, blah, blah. Horrible to trade in. Horrible. Absolutely horrible.
Yeah, but still, if you have patience, it will pay off regardless. I mean, it doesn't matter like what you're choosing in here. If you have patience, you're gonna still make money.
Yeah. So let's see if we could find something. So price is going down. We're still looking for long positions, and we are seeing a death or a golden cross forming right here. Right? So we have our candle closed, and it's now above. So then we can look for a possible long. So if we go to the, I need to set the, so first I'm going to be looking for a long, something like that. So I need to find a long here. I'm not going to set anything just yet. I need to find a better entry and risk reward ratio. So we could look for something like this perhaps. So this maybe not too greedy like here. Yeah, that should be okay. And perhaps our stop loss can move a little bit lower if we find the right entry. So because right now it's difficult to enter, right? If we enter here, we could do it. We could set it like this. But that's a nice risk reward ratio. But it's also tricky because especially when you see it like here, there is some sort of price debate going on. So we do need to look at lower time frames. So we're looking at the lower time frame. And we can see the price is also trading upwards. Right? So we could say, let's have a look. And if the price now touches this moving average again, then we could probably be looking for a long position with our take profit target to roughly around this level, like that.
Okay.
I think that would be okay. So we could set up our long position with a stop loss just like there and our take profit right there. Right, so let's see what that does. And let's just reduce this a little bit. Okay, so we're in the market. And we can see the price moving. There's a lot of movement happening.
This is the moment when your heart beats like crazy.
Yeah, when you see the price tank like that, then it's always a difficult situation. But when you have a little bit of patience, and probably when you walk away from your computer, because this is not some place where you want to be right now when you see all this this price action happening. And especially the sideways movement is always killing. But as we're still, even on the 15, we just touched a 200 moving average on the 15 minutes, so not on the hour. And we touched it again. We could have even targeted this.
We were already in profit if you're gonna, if you had there the take profit.
Yeah, and then maybe we could have entered another trade here. But it's okay. We looked at a nice risk-reward ratio, and so far we're still in the trade. And it's
also depends how you want to trade. I mean, if you want to be more like for a long period of time, or you want to look for short time frames and have multiple trades. I think that's more of a personal thing. And so close. Yes. Boom. Okay.
So that's our first take profit target, right? So we can see that it's actually moved even further.
Even more. Yeah. Huh.
So nice. Now we have our first profit.
So we made the 3.2% profit?
Yeah.
Whoa.
So 3.2% in 2 days in this case.
Okay.
But it's a 2.7 risk-reward ratio. So that's actually 2.7% on your portfolio in 2 days, which is not bad. Not bad at all.
No, I like this setup. Yeah, it's funny to see how some people that are just starting and have looked in the market and they've seen like 15 or 20%, profits that they can gain out of the market, and they are sometimes looking at 7 or 8 or 10% like being low. And then what I'm telling them is like, hey, if you want to go at the bank and put your money in a deposit, see how much money you're gonna make per year, or something like that. I mean, it's crazy. I mean, 10% per year is a really, really good return.
And actually, we missed maybe another opportunity here because, if we look at it here, we can see that on the 1 hour, it's another golden cross here.
Yeah.
So then we can have a look. Was there an entry? So it moved up there. So we could have entered here with the stop loss right there. So this is just something that we didn't take because we missed it because we were looking at another target. But also in terms of recent targets, there is not much to go on. So we would either have to find a better stop loss location, which is difficult, right? So especially now, but here or even here on the 15-minute 200, this could have been something. Right, and this is how you try things out in your backtesting sessions. So you find out how strategies could work and play out for you.
Yeah, and Ben, remind me, I can save that as an indicator, no?
The moving average, yes.
Okay.
So let's see if we could find another one. Maybe I think I just missed one here.
Yeah, that's.
So let's see if there's anything in here because this is a sharp move. But we can go back here. Actually, did we miss anything? No, because we're on the 1 hour and the price just goes up, but it didn't form that golden cross, right? So even though the price is up and went through it, it's not the golden cross. So there was no entry there. Right, so now we're getting into the shorting area.
Yeah, I see there we have, the crossing.
Right, so let's see what happens here. So we do have a golden cross or a death cross right here. So we could see if we could set up a short position from somewhere from here. Maybe with a stop loss right there and to take profit right there. that would be decent. 2.7 would be okay. So let's see if we could find an entry on the 15 minutes that might be better. Actually, I think if we go here, see if we can get filled, and then perhaps our stop loss on this swing, that would increase our risk reward ratio. Let's see if that works. So we're going over to the short. Let's just remove this for now. And we're setting up a take profit at this area. And we're setting our stop loss like that. Okay, let's see.
I'm curious.
Okay, so we got filled.
I think from my taste, I will put like the stop loss a bit higher, but yeah. No need. Oh my god, this trade was like, yeah.
This is another decent trade, because if you looked at the risk reward ratio, it's a really good one, especially when you're using the correct leverage and risk size, using the risk-based calculation inside Altrady, of course.
Yeah.
Okay, let's see if there's more, because now if we switch to the 1 hour, we are really dropping far like that. And actually, I didn't even follow my strategy properly, and I got this trade. But this is a risky one. This is a risky one because the reason why this is a risky one is because actually it's above the 200 moving average on the hour. So we should have been looking for a long, and instead it was looking for a short. So that's the now actually in this area we should be looking in the for a short. So this was this one just a bit lucky, I suppose. And it works, right? If the price moves up really far from it, then there is a high risk of it retouching the 200 moving average. But obviously, the strategy that I explained did not include this one, but it worked out anyway. So now we're looking for our first cross. So here we see that it's touching the 200 moving average, right? And we can see now we're getting another rejection of it, but no cross. Right, the cross was still here. So this was the correct entry for this this move, of course. But in terms of waiting before the 200 moving average, so now we have a potential one coming up again, because there is a golden cross, but we're below the 200 moving average. So we're not going to be looking for the long, but we're going to be waiting and seeing if and when it turns into a death cross, which is what's happening now. You can see that the line is not below it.
Yeah.
So we could look for that short. We could use this as an indication, and we could look for this one like that. That's our first liquidity zone, first target, and then you have a 6.46. Okay, now let's look if we can find a better entry on the 15 minute. And yeah, actually it's like this, seeing if we can enter, because it's actually a good entry already. So we could maybe just, in this case, you could consider doing a markup, because the death cross has happened on the high time frame, and on the low time frame, the death cross has happened here, and we're currently trading below that. So we could enter that short position with that market order, like so. Using these levels of support and resistance as our stop loss, and then setting this one like that.
Yeah,
like that. Yeah.
Man, the risk reward ratio. It's
No, actually, I'm going to play it safe because this is the safer bet in this case, and then we have that 5.6, which is still 4.8 in this case. That's still good. So let's do that. So now we're in the trade. And yeah, if we had put the stop loss there, then we would have been stopped out.
Yeah.
So the safer bet was the liquidity bid on the high time frame.
Well, let's see what happens.
Yeah, you can see the price is still debating on the 15-minute, but we're definitely still below the 200 moving average on the 15-minute time frame. And then all of a sudden you get some sell action. And we could probably speed it up a little bit.
Yeah.
I mean, obviously, this one is already a good, another bounce of the 200 on the 15. Are we going to get there eventually?
Ooh. Man, so close.
Oh, there we go.
Okay.
There we go. 4.8% in this case. But
not
that
bad.
5%, that 5 risk reward ratio. So let's look at our history. We have that, and we have the 3 trades. They're pretty good. And we started, so this is in 10 days, and we have several decent opportunities that we've traded. So this is this is how you would backtest your strategy. And I've done this backtest earlier today, obviously, but I was going in blank. I tried to do things the honest way. So that's what I've done today. And I've looked for these. Actually, this one I didn't do in my testing session. This one was just a lucky guess. I had a couple of others that I missed this time. Oh no, actually in my other backtesting session, I was also testing bounces of this. So for people that were watching the Tuesday webinar with the order flow, there is that possibility as well where you have the retouches against the slow moving average, and then if it bounces off that one, then you could enter another short. So basically the options here were like you could have your short here with basically here. So there are other ways to perfect this strategy or to find more entries in the same time frame. And the thing is that you can use the moving averages like this, like what I've shown you, and find a strategy that works for you. And then you can use the Altrady backtesting tool when it's ready to actually learn your strategy, right? I've done this now only today, but if you're committing to a strategy, then you need to do at least 10 or 20 hours of backtesting before you could actually have any feeling of the strategy and if it's working for you in the long run, right? And with the backtesting session right now, well, we're in less than half an hour. We've done 3 trades, so maybe 6 trades an hour. 20 hours, you'd be looking at, I don't know, maybe 120, 150 trades per hour, depending on how the market is responding for you and how it's working, which timeframes you've chosen, and obviously how quickly you can do this. Right now I'm talking with it and I'm putting the speed to 10 or 3, but you can also use the speed at 100 to speed things up more quickly. But yeah, this is essentially a way to trade moving averages.
That's solid. I really like the fact that you are able to see all your progress with the backtesting. So when you open the panel and you can see all the trades and be able to see all the P&L for each trade.
Yeah.
Yeah, I think that's really powerful. I mean, this backtesting tool starts to become really solid.
I agree.
I mean,
well, I mean, these things are still dummy text, but this is real.
But exactly that because I've checked the data and that's real, and I think it's awesome. So as you said before, if you want to test for like I don't know how many times, then you can really track your progress and you'll be able to see exactly how many times you were correct. And yeah, that's a solid.
And perfect your strategy, right? So try to find setups that that maybe you're not comfortable with yet. Then you try it in the backtesting.
Yeah, Roman also says backtester looks so handy. Yeah,
Like, when it's working fine, Roman, it's a blessing. It's so cool. It's way better than. I mean, obviously now we're just using a single target, right? But you could also use the multi-targets, where maybe you were targeting this take profit with a first level, and then maybe you could add another take profit target like that, and then see the results for that. That's not many backtesting tools out there that show that.
It's probably not ready for smart money concept yet.
I think it will be working fine on Tuesday when we do another backtesting session. I really like these backtesting sessions actually. It's just more fun this way.
Yeah, and also it's a bit engaging. I mean, just looking at like the reply function and just looking at the charts to see if you're right or wrong. That's also some really cool stuff. It keeps you engaged.
Well, the thing that I like about this the most is practicing to keep my hands off the keyboard, right? Because even in the replay function with this backtesting function, I'm so inclined to open up my position and to move a stop loss to a profitable position, only to see like when I would do that, I would like when it's here, I would move my stop loss to there and I would be stopped out, right? Or even if it's here, I would be stopping out there. But you're missing these profit targets when you do that. So it's so important to test your strategy and then stick to your strategy and then practice the ability to not touch it. It's so tempting. It's so tempting to adjust your chain of thought and to adjust your risk mid position. But if you've backtested your strategy, then you don't need to do that, right? And obviously, the more realistic that you do this, the better you understand your success rate with your strategy. And what I mean by that is of course you can look at the chart and keep in mind what the direction of the chart is, so that you could say, oh yeah, I'm going to go long now because I know that it's going to go up higher. That's not fair, right? That's not a fair backtest. And I'm not encouraging you to do that. I'm encouraging you to do the backtest and to do it exactly as your strategy tells you. And later on, we're going to help you with that. So to make it even easier to follow your strategy but you can already start doing that by keeping the journal, keeping track of the reasons why you entered the trade, ticking off your strategy list, and allowing yourself to be honest with yourself and say, this is how I would have traded in real life. Google updater again. Hello. Don't know why.
No, but that's solid. I mean, that's actually how you have to think of when you want to trade, and the way you should think about trading. It's not like gut feeling, what you said before. Yeah, I think that the market will gonna go up. Try to stick to it. And you were mentioning as well, maybe it will be good to just reiterate about like what will be a good risk reward ratio, Ben, for the trading.
That really depends on your strategy, right? If you have a strategy that is successful 80% of the time, you can have a very low risk reward ratio because it doesn't really matter if you lose once. But if you have a below 50, like let's say a 40% success rate, then you need to have at least a 3x risk reward ratio, meaning that you could be wrong 3 times before you lose money. Right? So if you have 1 winner, 3 losses, then you would break even. So a lot of traders, they tend to look for that 1 to 3.
Okay.
Just so that they can be wrong more times. But as you've seen perhaps in the Tuesday webinars, is that especially in the last one where Roman was telling me, like, you don't have to be that conservative all the time. Like, you could aim for the high liquidity places, right? So for example, if we had done that here, so here, and we would have had our stop loss like that, then we could have targeted perhaps this level.
Yeah.
And that's 6 already. And depending on the entry, like if the entry was good, then as soon as you move your stop loss down, if you can move it down, if you have valid reasons to move your stop loss down, this move would be 17 risk reward ratio. Right? And if you have a strategy that fits this and tells you that you're right, I don't know, 40% of the time, having 17 risk reward ratio, you could be wrong a lot of times actually. You don't need to be wrong 60% of the time. You can be wrong way more than that. Right? But it's just a matter of like, how often does this happen? How well does it fit your strategy? And can you find the correct entries? Because it makes a huge difference whether you set your stop loss there or there.
Yeah.
Right? But you don't want to set your stop loss too close, because even though it gives you a high risk reward ratio, the risk of this position may be far larger, because if there's a lot of price movement in that area, then you could be stopped out more times. So actually, even though this is a high risk reward ratio, you'd be wrong more often. Whereas if you have this, then you give the position a little bit more room to breathe, and maybe you'd be right more often. Right? And then if you're right more often, then you need then you can do with a less risk reward ratio. So that's what it comes down to. And obviously keeping that journal and learning from your mistakes. Like in this case, I've made that mistake, right? This was an off strategy trade. And now I got rewarded with profit. But it's still bad. So I need to tell myself this was not the correct trade to take, right? If your strategy is to trade long above the 200 moving average and short below it, then that's what you should do, right? So this was incorrectly rewarded with profit. But perhaps you change your strategy with the moving averages like this, and you say, no, you know what? If the price, or if the gap between the 21 moving average and the 200 moving average is so far, if I see a death cross, the chances of it going at least to the 200 moving average increases. That could also be a strategy, right? And that's a valid strategy. There's a validity towards that. Like if here you could see it as well. The price moved so far away from the 200 moving average, and then it popped back down. So entering in the golden cross or in the death cross right here to go to the 200 moving average, perfectly good example of a good trade. Same here. Cross, back to 200. Same thing here. Very high, or even here, very high, back to 200. Right? And yeah, here they are, and this would have been a bad trade. This is just a grind down, but even then it's closing the gap towards the 200. Right? So if you had taken this trade with a stop loss right here, then you would have been stopped out here. So you had this really long sideways movement. So it just depends on your strategy, right? And how you find the correct entries and exits.
Ben, are you using also different indicators with the moving averages, like RSI or MACD or something
Yeah,
like that?
you can actually. So right now I didn't do that, but you can actually add the relative strength index with that as well. So if you seek more confirmation, then you could say, because the relative strength index is the reason why this might be a good indicator to have next to it is that this is a leading indicator, right? So this will tell you whether or not a price correction is incoming. And especially if you look for divergences. So here you could see the price going up, but the RSI is going down. Right, so that's the bearish divergence and indicating a bearish movement. So if that's your strategy, then this would have been a very good one. So if you're waiting for a bearish divergence and you see the death cross, then you enter and you ride the wave till, well, there's another golden cross, so right here, then that would have been a decent profit, right?
Oh yeah,
Like
fine.
that, 9%, not bad.
No.
So that's another way that people do this. So that they don't just look for the death crosses and golden crosses. They also look for bullish and bearish divergence. Right? There are plenty of examples of where that's the case. Right? Price going up. There's a small bearish divergence right here. Price is still going up in this area. See? There are different directions. And then you have the sell-off going back down to the 200.
That's actually like spot on. Yeah.
In hindsight, everything's spot on. So that keep that in mind. So it's about hitting the backtest and looking at it fresh, right? So the thing is, like, okay, you say that, but if we go back here, yeah, sure, we'll go like that. Like, would you say that? I mean, it's a good one.
Yeah.
Right, but now, okay, so now the move is happening. Right, so where do you enter? Like, because the golden cross is here.
Yeah. Man, yeah, it's a hard one.
Right, so what would be your entry? Like, it can't be the golden or the death cross because, well, if it was there, then your profit would already be gone because entering here leaves you this, and your stop loss is there. So that will give you a risk reward ratio in the opposite direction. It's not ideal, obviously. So yeah, it's about, looking at the market in this scenario. Like, in hindsight, it's easy. Just sell there. Just sell there. Yeah. Okay. But why? What indication did you get that selling here would be good? Right. That's a strategy that you need to teach yourself and fully master and understand.
And it's funny. This is one of the things that most of YouTubers that are talking about trading are missing out to say. Nobody says that. They're just like showing like profits and how easy it is to make profit and so on.
Yeah, but it's not. It's really not. It you really need to go into educating yourself more. And of course, we show you profitable trades, right? We do that as well. That's more of an encouragement to say, like, when you master this, and we give you the tools to master it. When you do that, then these are the profits that you could make, right? And that's not a lie. They're in the chart and they're following the strategy, right?
Yeah.
As long as you're clear about doing the backtest and following your strategy, then it's okay.
Yeah, we are doing our part as much as possible. That's true.
Yeah, I hope so, at least. I hope that we're teaching you that becoming a good trader requires a huge investment of time. Time to master the charts, time to train your eyes, spotting these types of things. Like, before, when I just started out trading, I wouldn't even have noticed these bearish divergences or bullish divergences in the chart. I wouldn't. Right?
Yeah,
it's only after I've done this for several times that I now see them.
You need time. I mean, your eye has to be trained, and in order to do that, you just need to practice.
You could see a small one here.
Yeah.
Right? Golden cross, buy, hold till kingdom come, like here. You'd be golden. All right, I think we're coming to the end of our webinar.
Yeah, that's correct. If there are no other questions, guys.
Yeah, I'm curious to hear what people think about this. Like, and obviously, if you don't have the questions now, join our Discord, because we still have that Discord server where we do like to interact with people. And we do like to answer questions that people have. So if you have them, don't be afraid. Just ask.
True. Correct. Well, thanks a lot for today, Ben. It was really insightful, and yeah, you shared a lot of great information and knowledge. So thanks for that. And for all of you back home, have a great day, evening, and so on, and see you the next time.
Yes, see you again next week, same time, same place, same people. And have a great weekend coming.
Yep.
Take it easy. Don't trade too much. It's weekend. Enjoy it. All right. See you later. Bye-bye.
See you. Bye.